Let me ask you something. Do you remember where you were in 2008? Maybe you were in school. Maybe you were working. Maybe you remember the panic headlines, banks collapsing, markets crashing, people losing homes. Here's the uncomfortable part. Right before it happened, most people thought everything was fine. Housing was booming, stocks were climbing, credit was easy. And then it cracked. So here's the question no one really wants to answer. Is another financial crisis coming? Because if the last one taught us anything, it's this. Crises don't feel obvious before they happen. They feel stable until they don't. Stay with me, because by the end of this video, you're going to see the warning signs differently. And there's one indicator near the end that almost nobody is talking about. Before we panic, let's define something. A financial crisis is not just the market going down. Markets correct all the time. A real financial crisis happens when the financial system itself breaks. Banks stop trusting each other. Credit freezes, liquidity disappears. And once credit disappears, everything slows. Businesses can't borrow, home buyers can't get mortgages, investments stall, confidence collapses. That's what happened in 2008 with the collapse of Lehman Brothers. That moment wasn't just a bank failure, it was a signal. The system wasn't as strong as everyone thought. And here's the pattern. Financial crises are almost always triggered by one thing: excess. Too much leverage, too much risk, too much confidence. So the real question isn't, will there be another crisis? There will always be another one eventually. The real question is, are we building excess right now? Let's look at the pressure points. Start with debt. Corporate debt, government debt, consumer debt, all near historic highs. Now look, debt alone doesn't cause crisis, but rapid debt growth during low interest rate environments, that's historically dangerous. After the 2008 crisis, central banks slashed rates. The Federal Reserve cut rates near zero, and they kept them low for a decade. Cheap money changes behavior. When borrowing feels cheap, risk feels small. Companies borrow aggressively. Investors chase yield. Asset prices inflate. Sound familiar? Now here's the shift. Interest rates are no longer near zero. They've risen sharply in recent years. And when rates rise quickly, debt becomes heavier. Companies that borrowed at 2% now refinance at 6% or 7%. That's not minor. That's margin compression. That's layoffs. That's pressure. But here's the open loop. Debt alone isn't the most fragile part of the system right now. There's something more sensitive. We'll get there in a minute. The banking stress signal. In 2023, we saw something interesting. Regional banks began failing. One of the most notable was Silicon Valley Bank. Now pause. This wasn't 2008-level systemic collapse, but it was a stress signal. What happened? Rapid rate hikes reduced the value of long-duration bonds banks were holding. At the same time, depositors moved money seeking higher yields. Liquidity pressure built. Confidence wavered. And once confidence wavers in banking, that's when things move fast. Banks operate on trust. If enough people withdraw at once, even a healthy bank can struggle. Now here's the point. We avoided contagion that time. Regulators stepped in quickly. Liquidity facilities were opened. Confidence stabilized. But events like that show something important. The system is sensitive to rate shocks, and rates moved faster than they have in decades. So ask yourself, what happens if another shock hits while the system is already adjusting? That's the compounding risk. Financial crises often follow asset bubbles. In 2000, it was tech stocks. In 2008, it was housing. Today, It's more complicated. Housing prices surged dramatically after 2020. Low mortgage rates created massive demand. Then, rates spiked. Now, affordability is strained. Is it a bubble? Not necessarily, but elevated asset prices combined with high leverage create fragility. And then there's the stock market. Valuations remain elevated compared to historical averages. Now look, high valuations don't automatically mean collapse, but they do mean expectations are high. And when expectations are high, disappointment hits harder. Financial systems don't like sharp repricing, because sharp repricing triggers forced selling, and forced selling is how instability spreads. Okay, up to now, everything we've discussed sounds manageable. Debt is high, rates are higher, banks experienced stress but survived, so maybe we're fine. Here's what most people miss. Crises don't come from what everyone is watching. They come from what everyone assumes is safe. In 2008, mortgage-backed securities were considered stable. Before the dot-com crash, tech valuations were justified by new era thinking. Complacency is the common denominator. And right now, the biggest assumption is that central banks will always step in. That belief changes behavior. If investors assume rescue is guaranteed, risk-taking increases. This is sometimes called moral hazard, and moral hazard builds hidden fragility. Financial systems today are more interconnected than ever. What happens in one region spreads quickly. Look at how fast the 2008 crisis spread globally, or how quickly markets reacted during the early days of COVID. Global debt levels are at record highs, not just in the US, worldwide. And here's where it gets interesting. If a shock hits in one major economy, capital flows shift instantly. Currencies move, liquidity tightens, financial stress can become synchronized, and synchronized stress is harder to contain. This isn't fear-mongering, it's structural reality. Earlier, I mentioned an indicator almost nobody is discussing. Here it is: liquidity. Not headline liquidity, market liquidity. When markets function smoothly, buyers and sellers transact easily. Spreads are tight, volatility is contained. But when liquidity thins, small shocks cause large moves. Recently, we've seen occasional episodes where liquidity conditions deteriorate quickly. Bond markets move sharply, funding markets tighten. Nothing catastrophic, but thinner than usual. Financial crises often follow periods where liquidity slowly erodes beneath the surface. Everything looks calm until suddenly it's not. And here's the uncomfortable truth: liquidity is invisible until it disappears. Let's zoom out. Debt is high. Interest rates rose rapidly. Asset valuations remain elevated. Banks have shown sensitivity to rate shocks. Global leverage is substantial. Liquidity isn't as deep as it once was. Does that guarantee crisis? No, but it increases fragility. And fragility means the system has less room for error. Financial crises require three ingredients: excess leverage, a catalyst, and loss of confidence. We can identify the first. The second is unpredictable. The third happens quickly. The real danger is timing. Nobody rings a bell before crisis hits. If another financial crisis were to unfold, it likely wouldn't look identical to 2008. It would reflect today's vulnerabilities. Maybe it starts with a credit event. Maybe a large institution mismanages risk. Maybe sovereign debt stress rises. Maybe geopolitical escalation triggers capital flight. But the pattern would be similar. Volatility spikes. Credit spreads widen. Funding tightens. Confidence drops. and policymakers intervene. Here's the difference this time. Debt levels are already elevated, which means policy flexibility is more limited. Central banks can cut rates, governments can spend, but the margin is thinner. That's what makes this cycle different. Should you be worried? Here's the balanced answer. Financial crises are part of economic cycles. They are painful, but they are also cleansing. Excess gets removed, risk gets repriced, and the system eventually resets. The question isn't whether a crisis will ever happen again. It's whether the current environment contains enough imbalance to trigger one soon. Right now, we see pressure, not panic. Fragility, not collapse. But fragility matters, because fragile systems break under stress. Here's the final thought. The next financial crisis will not look obvious beforehand. It will look rational. It will look explainable. It will look stable until it doesn't. That doesn't mean panic. It means awareness. Understanding cycles gives you an advantage. When others are euphoric, you stay measured. When others panic, you stay analytical. And here's the truth. Those who understand the system are rarely surprised by it. If you want to understand how debt, interest rates, and central banks connect to this bigger picture, that's what we explore next. Because crises don't start with chaos, they start with imbalance, and imbalance always leaves clues. The question is, are you paying attention?